talk a bit about area patterns. Now, some of you who've attended my technical analysis seminar, some of you have probably seen this, but a vast majority of the crowd here have not attended one, so I'm going to have to clarify some matters. You see, when we're looking at these particular things, area patterns are these pause points in the consolidation chart where they go sideways. There are two types. We have one called a continuation pattern, and we have one called a reversal pattern. A continuation is simply this. Here comes a trend going up, goes sideways for a while, stops, and then moves up again. So it continued the trend that it had just done. Another type is what we call a reversal. So it goes up, goes sideways, and then turns the opposite way, just like the picture you see there on the right side. The reason we want to know that is because it wants to be able to tell you, remember this, there are two exit points from a pattern, not just one. So if you know that, once an area pattern comes in, don't you believe that it will automatically go up. Remember, there's a potential it could reverse and go the opposite direction. So you can only act when you feel and you can see evidence that it's really pretty much going into that next direction that you anticipate. If you don't have that sense and you can't feel excited about it because it doesn't give you that, then you're not supposed to act in anticipation. Okay? You have to be more likely sure rather than just casting yourself in there. All right. Now here you can get some clues. The shape of a pattern is seen after you draw your support and resistance lines. So in this particular case, there are two lines on the first one. If you notice that the resistance line here is flat, the support line here in the bottom is also flat. Now when the lines of resistance and support are flat, a flat line in your support line or resistance means that the buyer, and in this case the seller, they just want to sell or buy at that price. They're not interested in pushing here or demolishing whatever. They just want to buy or sell at that price. For example, how can that happen? Let's say, for example, have you ever put a GTC order? And now the reason you put a GTC order, or good till canceled order, is because you say, all right, if ever the price goes up to this price, sell my position. Sometimes it'll hit it. Sometimes it will complete it in one go. Sometimes it might take 1, 2, 3 days before you complete a GTC order, especially if it's big. So what it simply means is, as long as the price goes to that area, okay ka na. You want to liquidate that position. And imagine if many of you guys are doing the same thing. So that needful to be able to sell that position comes over time. And that's why you're putting a flat resistance or cap. You're not adjusting that every day. Similarly on support, if you want to buy a stock at 10 pesos and you don't want to raise it to 12, then the demand will only show at 10. And that's when a flat level of line of support will appear. Now the reason I'm telling you this is because the shape of those two lines can give you advanced reading of what's about to happen in your stock. Now you think about it. If, for example, I have this non-aggressive buyer and non-aggressive seller facing each other in a sideways range. If you're both non-aggressive, that means the stock will just go up and down, up and down, up and down because neither one of you are pushing against each other. But look at the next chart. Here you have a flat resistance line. And your flat resistance line is telling you non-aggressive seller. But look below. Your line here is going upwards. And as support is pointing up this way, that's telling you that the buyer is willing to raise his price. He's becoming more aggressive. Now, he's becoming more aggressive because he might need to buy that in a short period of time. For example, if I was a big fund manager and I give my broker an order to buy, I'll tell him, okay, broker A, buy me that stock. I want you to buy me 10 million shares of Ayala Land, and I'll give you 1 week to do it. So since there's a definite time involved there, the broker is going to say, all right, I'll buy it little by little over time. But if I find out that I cannot buy all those shares at one price, remember, I only have a week to carry this out. So what will I do? I'll be raising my price little by little because I'm going to try to finish my buying in that schedule. So buying becomes more aggressive. The willingness to push the price comes in. So now you face the two forces against each other. You have an aggressive buyer coming in, pushing, 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 pushing. Well, the seller's just there, taking his own time, selling at the same price. Eventually, you're going to reach him. And as you reach that, you will easily take out the supply levels above you. So the potential to move out of a pattern like what you see here in the bottom, this potentially could go higher rather than either way. So there's greater chances of this pushing up than it is pushing down. And here is where the shape of a pattern tells you or gives you better insight as to what's about to happen to that stock. More likely, this is going higher. This is called an ascending triangle, where the first one is called a rectangle pattern. So by knowing the attributes or the shape of a pattern gives you clues as to which way the pattern will more likely go. And this is the reason that you will have that poster now, because in your poster you will find different patterns like this. If you notice your poster, it would look like this image that you have here on the right side. Now, we've arranged it so that you can see which one is a bullish pattern and bearish pattern. It's also been arranged so you can tell whether the pattern is something that will likely continue a trend or whether it will reverse a trend. That way, it's easier for you, so you have a nice big código to be able to use when you spot it. When you start looking for a pattern in a graph, please don't look at this poster and say, ano ito? Double tap. Tignan ko nga, mahanap ko itong. Believe me, you're going to find one, even if it's not there. All right? So the way to look for a pattern is simply doing this. Look at your chart. And when you're looking for a chart, let's say you're looking at the first one here. Just mark out, oh, I see a top here, I see a top here, I only see one bottom so far. And then just mark it. Maybe you can mark out the tops in red dots, the bottoms you can mark out in blue or green dots, and then just connect them together. Once you connect these two together, then you say, all right, does this pattern exist in my poster? That's the better way to do it. Because if you do it the first way, we call that form fitting. You're putting your mind into a situation where it's going to manufacture a pattern even if it's not there. Right? So connect the tops, connect the bottoms, connect it to the line, and now take that shape and form to your poster and check, which one is it? That's the way you should use it. Okay? All right. So remember, put the lines of the pattern together, and if you can see that the basic sense of it is, let's look at this one here. Here you have a flat bottom line, so that means the people buying here only want to buy at that level. The people selling are forcing the price down. Who will win this war? The seller or the buyer? The seller. And so, use that to your advantage. So that at least here you can say, if I'm going to anticipate, then okay, that's an example of a deadly pattern. I don't want to be buying that one. Okay? So be careful of that particular pattern. Now, in terms of the reversal patterns, I think the only one thing I want you to memorize will be the first one. This, by far, the double top or the inverse of this, the double bottom, is the most prominent reversal pattern there is. Some of you like looking for the head and shoulders. If you find one, good luck. It'll happen every once in a while only. Although somehow when people look at, wow, I've spotted the head and shoulder. Congratulations. Right? But the double top or the double bottom are the one you memorize because 90% of those reversals stem from that pattern. This is actually a double top. It just has a slightly lower height than the previous one. So if you spot this part of a head and shoulder, it's like spotting a double top anyway. So just focus on that. And just remember this point in fact. When a market hits a high, that's a trend movement going up. From a trend, strong uptrend, it will stop. And it will create a pattern first. And so here's an example of a pattern. It hits a stop, makes a correction, climbs back to the previous high or near it, and then it reverses. So that is a pattern in itself. On the bottom, the same thing. It falls down, rallies, goes back to the previous low, and then it rallies. Most of the downtrends and uptrends you'll see will end using that pattern. And I'm telling you this because there's a need for that market to confirm that top is there. So uptrend, stop. It will just completely deteriorate. It'll rally, attempt to go back to that high to see if it can break it. If it cannot break it and it falls down, then you will see a wider correction come in. The market needs to confirm its movements. And it needs two highs or two lows to establish that there is a ceiling there or there is a floor here that can hold me. So that's why normally, after a plummet in price, I will never buy the first bounce. Never. You can convince me fundamentally as much as you want.